Chapter 7 starts off with a very interesting concept: fraud and internal control. This is the first half of what we're going to be doing today. The second half looks specifically at cash uh, from the eyes of a bank. Because the bank, what's going on with your cash. Guess what? So does the bank. um, and a cash budget, how much money we are expecting to have and need through every quarter. One and two, it's still internal controls are discussed in both. So I kind of do these together. They sort of meld together pretty well. Okay. All right. So first things first. Um, the book has a relatively narrow definition of fraud here. Of course, fraud can be applied in a number of different ways. But in this case, the definition is narrowed to a dishonest act by an employee that results in a benefit to that employee, but at a cost to the employer. And so that's our very narrow view of fraud in this chapter. Okay. Um, and why do they say that? Well, basically because your employees have access to some of very important assets that a business owns. Employees handle cash. That's a very important asset. So if you are a cashier, or you might be part of a waitress staff where you're handling cash or processing payments in that way, you have access to cash that becomes part of their revenue, perhaps. Um, Employees have access to supplies of the business. They have access to inventory. Um, they do have access to some property, plant, and equipment, but it's unlikely that you're going to put a building in your pocket and walk home. But there's certain things in which fraud still applies, even all the way through. Your book labels things as three factors have to come together for fraud to happen. And like I said, the very first factor is employees have the opportunity to handle your assets. Cash is the most vulnerable of all the assets. If you walked down the street and you looked down and there was a $20 bill there, you probably just pick it up and keep walking. We don't usually, no one would be, picking up saying, did anybody drop a 20? Then everybody would say, yeah, that's mine. Normally speaking, cash is the most vulnerable asset that businesses have, because how do you prove ownership? How do you prove it didn't fall out of somebody's pocket? So there's opportunity there. But like I said, certainly too with supplies, inventory, there's opportunity to access those assets. Opportunity alone isn't enough, right? Everybody has financial pressures. We live in a time where um, our dollars that we earn don't always buy us the best standard of living. Housing costs are very high, transportation costs are high, healthcare costs are high. We need energy to heat the homes these days. Food is an issue. I mean, it goes on and on and on. We spend a lot of money on basics. And then add to that the lovely little the lovely little habits that some people would call addictions pop in, such as, being addicted to drinking or smoking and spending a lot of money in those areas, being addicted to gambling, being addicted to shopping and spending lots of extra money in those areas. So, we have all these wonderful little habits as humans, and they cost money. And they cost money. So that adds a lot of financial pressure to people, because we are, no one's perfect. We all have something going on that makes life a bit complicated and adds some financial pressure. So you take the opportunity together with the financial pressures that we feel, and that doesn't mean people are going to take stuff. However, you need the third branch here, the third corner of this triangle, Rationalization, what does that mean? Well, in short, you have convinced yourself that it's okay to do something that's not okay to do. Okay. So, we learned since kindergarten, you're not supposed to take things that don't belong to you. We all know that. I mean, it's probably zooming around in your head at 1,000 miles an hour from childhood up. We know that. But yet the rationalization comes in. It's like, well, I deserve a raise. And this is a multi-billion dollar company. They're not going to miss this 20 or this 50 or whatever. That's rationalization. It doesn't really matter how rich the company is or how it seems. It's still their money, right? So that that's rationalization. The same thing true and is true when people handle inventory of the store. Oh, I love this. They have a bunch of them on the rack. I'm just going to take this one home because I'm an employee. I kind of know how to kind of hide it on the side and take it out of the store. Rationalization, right? And maybe that's because you think you deserve it, or they should be paying you better, or what have you. Or you looked over for a promotion, and you're angry, and so you want to take stuff to get back at them. Those are all rationalization types of things. But when all these three things come together, that's really what fraud is. The government is always reluctant to act in business matters, but when stuff gets really tough, um, and times get really tough, they do. The Sarbanes-Oxley Act particularly hit publicly traded companies, or corporations with lots of extra rules and regulations. One of the things that they have to do is they are required to put into place a system of internal controls that stop fraud from happening. And that's actually all the way up and down the list. So from, keeping safeguarding their assets like cash and inventory, you have to have a system of control, making sure the financial reporting is accurate. So you want to get other eyes involved to verify that things are going on and that it's legit. You have executives and board of directors that also have to certify that financial statements are correct and these controls are in place and they're effective, et cetera. Then they have to bring in an outside auditor, another set of eyes that looks at the accounting records to make sure they actually are following the rules that we call GAAP and can testify or attest to that fact. And then, of course, anytime Congress passes a law, you have to have a bureaucracy to carry it out because Congress makes the laws, they don't enforce it, right? So you need to create an executive branch, in essence, of sorts, an office to enforce the laws that governments make. And so the Public Company Accounting Oversight Board basically is the enforcers, of these regulations that have been put in place. But we're going to be focusing a lot on internal control here, and you probably have seen quite a bit of it in your lifetime, without really knowing it might be called internal control. The number one reason for internal control is companies have to safeguard their assets, right? I mean, companies are so large, they have so many assets, and it's important for them to be accurately keeping track of all of that. Okay, for the sake of the owners, this is their stuff. So that's the obligation that they do have. Internal control methods that are put in place supposed to safeguard assets. Because they're looking at how things are working, actually, more accuracy should come out of the accounting records, because those control features that have been adopted make things more clear to management, and they can act to make sure there's more accuracy and reliability in those records. Certainly, as they're doing that, they're making the operation more efficient. And then, of course, oftentimes corporations will have compliance officers to make sure that they are complying with various regulations that are put on them. Okay. We're going to look at some components of internal control. such as the environment, what type of risks are around uh, in most businesses in terms of loss, control activities, what's going on with information and communication about all these types of things, and how are things being monitored in general. Um, and so what we're going to be looking at is some basic principles that you've probably have seen. One of them is make sure you're establishing responsibility for certain things, for certain activities. So, for example, the cash drawer that's listed here in the picture. Um, if you assign it to a particular cashier, that only that cashier has access to that drawer, you've established responsibility because anything that's missing from that cash drawer, now that person needs to take responsibility for it. They are ultimately accountable to that. And so, oftentimes you'll have people that have their own drawers when they set up a cash register. So, establishing responsibility again, if one person is responsible for a particular task and something goes wrong or something is awry, something is missing, you know who you're going to ask first, right? So that's very, very important because it limits the access only to certain people in regards to those assets or other information. Another thing that you can do as a corporation is segregate the duties to make sure that different people are responsible for activities that are related to each other. So in essence, they're separate, but they should say the same story. So for example, here, accounting employee A is actually maintaining the record of how much cash the business has, right? Whereas employee B is actually handling the cash. So both employee A and employee B should have the same amount of cash accounted for, whether it's in writing on the books or physically in front of them, right? So that's important. The record keeping for an asset should be separate from whoever has physical custody of that asset. And that's true for cash, that's true for supplies, that's true for inventory, that's true for a whole bunch of things. And so this segregation of duties is an important control activity. Another thing a lot of companies require is having documents in place. So whether it's a pre-numbered document or whatnot, the documents are meant to have accountability in place. So whatever the source document is, oftentimes these documents need to be filled out by a certain person. They need to be signed off, and there's a paper trail to indicate who's been involved in this particular activity, and thus they can be questioned and held accountable in case something goes wrong. And then, of course, we've all had our sense of physical controls that we've been subject to. And so, whether it's putting in a password to get into certain places or have access to a drawer, that's one thing of which you can do, or you have fingerprint scan or whatnot. Um, you all know about your time cards. One of the things that time clocks help is to stop employees from stealing time, right? Because when they steal hours, they steal money, and that's also considered fraud under the definition here. So time clocks are really there to make sure that there's some control over that particular activity and there's a record of it. We've all been in stores that have inventory that it's monitored or behind glass or locked up in some way, shape, or form. Again, that's to deter theft, right? We all know that companies have all different types of alarm systems, and whether it's the actual alarm like this, if it's broken into, or if a customer or even employee tries to move past a certain point, it might set off a beeper of some sort or beeping sound. All that's very, very important. Warehouses are locked and secured, and only certain people have access to both the physical inventory and the record of what should be there. again, that should be segregated and certainly watched accordingly. Of course, when companies have cash, and all companies have cash on hand, then you need a safe or a vault, and then of course you need to figure out who has access to that particular safe, um, and so you can again establish the internal control activity. When a company is really big enough, they can get a third person involved to verify independently that what's going on is legit. And so earlier we had employee A who is record keeping of the cash versus employee B who's actually holding on to the cash. These records should match clearly, and this person here can verify as an independent internal verification person that these everything is fine, nothing is being um, mischievous here. And if there is a discrepancy, that's the person who's going to report, yeah, I see something wrong here. Human resource controls are also very important. Matter of fact, Sarbanes-Oxley gave lots of responsibilities and upped the ante for human resource controls as a way to effectively reduce fraud. In what way? Well, one thing is, businesses have to bond employees who handle cash. And, what a bond is, we're not talking um, 50 shades here. What we're talking about basically is insurance, purchasing an insurance policy on employees just in case they steal from you. Then you have that risk covered. So your employees often go through a number of, you do background checks. Part of the background check really is to make sure the employee is able to be bonded, is able to have insurance on them. And so if there's anything in someone's background that they've been convicted, for example, of stealing things, and whether that's petty larceny or grand larceny, it's not going to look good. And certainly they haven't learned their lesson of, you don't take stuff that doesn't belong to you. And so that could A, hold them from getting a job there, and B, it certainly is not going to make them insurable, you know. And so those background checks are very important in that regard. Also, when you do have employees, rotate them around. There's several. Usually, the larger the company is, there's lots of different things to do. Rotate people around, and things should still work the same. And you can also get feedback from people that are being rotated as to how those things are going. You can also pick up ideas from that. One thing that's really important too, believe it or not, is to require vacations. And it's kind of odd because we live in a country that we have the least amount of vacation time and of all the industrial world, for sure. And then, of course, a lot of people don't like to take vacations because oftentimes they just simply need the money. They simply can't afford to take a vacation sometimes. So, but let me tell you how this does work. When you're not there, particularly for a week or two, things should work the same as when you were there. And this happens. So, and I was working on in finance on very large funds, and I was required to take vacations because about 700, $800 million were coming through my desk every day in money market. And so when I wasn't there and someone else was doing the desk, there should be absolutely no changes in what's going on. And that's, if there is, that's a good way to pick it up. And this is what happened in Boston, actually a suburb of Boston, where I'm originally from. So Brookline is to Boston what kind of Brooklyn is to New York City. And I love going to, I always love going to Brookline. You'd have to pay, back in the day, you'd have to pay, there are meters for parking, dimes, nickels, quarters. I mean, it basically took anything, which is great. And of course, there were people that came and collected the money on a regular basis. And the city of Brookline um, was curious because there was a particular meter, well, they call them meter maids. It is degrading, but they called them meter maids back then. But there was a particular lady who was working the meters, and every time she was on vacation, the person who filled in for her on her route of collection always collected more money on her route than she did. And of course, when she came back from vacation, those receipts would go down again. Um, and they got very curious after recording all of this for a period of time that they were able to report it to district attorney. They had enough evidence to pull a subpoena. They pulled her bank records and they showed these regular. Of course, they know how much they paid her because she's on the payroll, so you can see how much they paid her. But they just noticed regular deposits going on a regular basis, and and she was caught. This is part of how you catch fraud, you know. So that's one of those types of things that are really incredible. And just to go back here, even to New York, where you have these folks that put in for all this overtime. I think it was down at the MTA or something like this. They put in for a ton of overtime when they weren't even working those hours, and it was because of that human resource control and their time cards and that audit that got them caught that they actually were stealing time uh, from from the state. So that was interesting. But these are very important controls. You wouldn't necessarily think human resources is connected with financial fraud, but it is. But it is. Okay, so you have a few stories about fraud here. This particular person here, Maureen, was a training supervisor at Colossal Healthcare, and she was training people on their claims processing program. So she would create fictitious claims that then would be sent over to accounts payable for payment. Once the training was over, she would tell accounts payable, "Oh, these are fictitious, don't pay them." However, she didn't always inform accounts payable that was fictitious, clearly. And so some of those fictitious claims were actually put in the names of entities that she controlled. And so when accounts payable paid that entity, they were actually paying her. She ended up taking $11 million. That is a colossal amount of money, and I'm sure that made them very sick at the healthcare company. See how I'm just pulling these words out of nowhere? No, um, but that's a heck of a lot of money to be doing that. So obviously, this company, which was big enough, obviously it's colossal. They didn't have an establishment of responsibility. They didn't adequately restrict who could authorize and approve claims. They didn't also they didn't even have a separate system for training, which was to me very stupid. But um, so they were using the live system to train people, and this is how this person got 11 million bucks because they were actually live from wherever they're from, not live from New York. But that's a lot. Here's Larry. I'll do another one with you. Larry was an assistant vice chancellor. That's pretty high up, like a VP, right? Communications at ASOP University. And he was allowed to make purchases of $2,500 without approval. So that means his signature was good enough. Okay. Unfortunately, Larry liked antiques himself and bought a lot of them. Okay. Lucky Larry, right? How do they do it, or how did he do it? Well, whatever invoices the vendor gave, he went and recreated them on his computer, and fake invoices. And these fake invoices, he just put wording and other things that, like all the other invoices were. So, thus, the accounting department looked it over and said, okay, these look legit, and paid them. Larry took about almost $500,000. Okay, now you know why your tuition is going up if you went to ASOP University. Larry took almost $500,000. That's quite an education that they got. Yeah, yeah, yeah. The missing control here was Larry was able to do everything. There was no segregation of duties. He was able to order He was able to receive the items and he was able to get the invoice. So he had control over all the documents that were necessary to perpetuate a fraud, and he did. Okay. So that's Larry Boy. And of course, there's a whole bunch of other frauds here that are from your book that you will be reading about because you're going to have to identify these as part of your homework um, in the first section here. Okay, so lots of fraud, sadly, um, lots of things. Here's one that's human resource control, because again, the fraud was detected because this particular woman missed work, and she never took a day off, earlier. So she took a day off. They noticed something very, very different, and boom. So yeah, I mean, it's really amazing what can happen here, and it's a very important thing that it is financial in nature. Accountants have to know about it. Management has to know about it. This is a very important, bigger topic. Okay. So again, the size of the business is going to matter because internal controls are easier to implement and less costly to implement when the corporation is huge, because you can break things up easier and put these things into place. What happens when you have something very, very small, a small corporation, maybe even 5 people, 10 people, 20 people? Whew, it's really hard to put controls in. I mean, in the smaller the place, there's a lot more trust that what people are doing is the right thing. Oftentimes, you'll find out much later that it might not be, but there is that trust that's there. So costs can exceed the benefit, and so for smaller companies with fewer employees, it's really hard to do that. But for larger companies, shouldn't be a problem. There's also, regardless of whatever the size and the cost, there's always that human element. We're a little greedy, at times, and we often don't think very, very well at times, and so we people are tempted to take things that aren't theirs. So there's that human element that's always going to be there. And so, basically speaking, that's what your do it exercises are about for learning objective one. Okay. What the situation is and what the solution is. So, this is the first thing that you're going to be looking at. Learning objective two says it's the exact same thing, but it's about cash specifically. So, but all the same procedures are there. So, whoever's handling cash receipts is cash coming into the company. Again, you want to make sure you know who's doing it, that it's documented, that certain duties are segregated, that it can be verified, et cetera. All the same controls are in place when cash is being received. Okay. Particularly if you have, you know, a lot of over-the-counter receipts, right? So segregation of that record keeping from the physical cash custody. So here you have in this column the clerk who enters the sales and counts the cash. The cash is then sent to the cashier to prepare the deposit slip. Boom, is there. But on the other side, you have a supervisor who removes the cash tape, is able to see how much cash is supposed to be there, report that to the accounting department as well. These two should match. These two should match. So this is just very specific to cash. Again, any mail that comes in, if it's all in the hands of one person, particularly when they're counting cash or receipts coming in, it's ripe for potential fraud. Doesn't mean fraud's going to happen, but it just could happen. Same thing for disbursements when cash is going out. You have a lot more control over things when you pay by check or you use basically an online banking type of electronic funds transfer because there's records automatically that are done. You can also use vouchers. And so that's what this particular part looks at. Okay. In terms of how, what employees actually steal, it's actually quite saddened that Most of the time, it's simply that assets are misappropriated, and so basically they take stuff. They take stuff. Um, and so employees take stuff, but so it's the most common. 85% of fraud is because employees take stuff from their employer, but it's actually the least costly to the employer. What's the most costly happens the least, right? Fraud. Um, and this is from a report on from the Association of Certified Fraud Examiners. So fraud examiners are specialized accountants in fraud. If you like fraud examination, it's sort of mixing accounting and crime and criminal justice together. And that is basically your first half of chapter 7. Let's take a quick break, come back and ask questions.